Recessions don't just erase numbers on a screen. They test what you actually own and what you believe about money. If you use the right moves, a recession can become a reset for wealth, not a trap. Today, I'll share a practical playbook you can apply, step by step, starting tonight. You can follow along and adapt it to your own situation. First, pause big discretionary spending for at least 90 days. Look at every monthly expense as a choice with consequences. Ask yourself what you truly need versus what you want when headlines scream doom. Put these purchases on hold and redirect that money toward an emergency fund or a focused investment fund. Reinforce your emergency fund to cover 9 to 12 months of essential costs. This is not a luxury. It is a shield that lets you stay rational during volatile times. Tackle high-interest debt first. The interest you pay during a recession compounds the damage. Create a simple plan. List your debts, rate them, and attack the highest cost first. Next, set a fixed monthly amount you will invest regardless of market mood. This is your baseline of progress. Use dollar-cost averaging to smooth out swings and prevent trying to time the bottom. Over months, your average cost finds its balance. When you pick stocks in a downturn, look for durable cash flow and real pricing power. Companies with pricing power tend to hold up when shoppers cut back. Strong balance sheets and reliable dividends help you sleep at night when headlines shout chaos. They provide stability when fear runs high. Many people default to a 60-40 split, but in a recession, you might tilt toward high-quality bonds and cash. Adjusting early can improve risk-adjusted returns over time. Think of your portfolio as a ladder of income and safety you can climb if markets fall. A well-built ladder gives you options rather than panic. A simple bond ladder uses equal rungs of high-quality bonds with staggered maturities. You can adjust the ladder as rates change, reinvest coupons, and keep some dry powder so you can catch new bargains when prices soften. Having cash ready lets you pounce without rushing. Dividend growth stocks with strong moats tend to hold value because customers keep buying. Look for sustainable payout histories. You don't need hundreds of ideas. A focused handful of quality names can outperform endless bets. Quality beats quantity in tough times. Make sure you maximize tax-advantaged accounts and capture any employer match. Those matches are free money in the long run. Tax savings compound over years, especially when you keep contributing during downturns. Small, regular contributions add up surprisingly fast. Build a watch list with prices you would actually pay for each stock or fund. Review it monthly and stay curious. Set a rule. Buy only when a price hits your target and only if it fits your plan. Discipline beats impulse every time. Once or twice a year, rebalance to your target mix to keep risk in check. Let data drive those moves, not fear. Avoid emotional trades driven by headlines. Stick to your rules even when the news screams. Your plan should guide every decision. Real assets like real estate investment trusts and certain commodities can protect against inflation. Use them sparingly and with strong fundamentals. Use these sparingly and focus on assets with low fees and strong fundamentals. Avoid overexposure to any single asset class. Run 3 scenarios in your mind: mild recession, deep recession, and recovery. Label the outcomes and plan actions for each. Estimate how much you can save, invest, and still sleep well in each case. This clarifies your minimums and your comfort zone. Create a 15-minute weekly routine. Review your budget, check your watch list, and adjust as needed. Small, regular checks beat big surprises. Each month, confirm automatic contributions and debt payments are on track. Consistency builds confidence over time. Avoid trying to pick the perfect stock or timing the market. The best move is often to stay the course. Don't let fear push you into selling when prices drop or into chasing hot tips. Fear plus noise equals bad outcomes. Don't ignore fees and taxes when you move money or switch funds. Low costs compound the most over decades. Don't chase every rumor or unreliable online signal. Verify ideas with your plan and data. Don't skip your emergency fund or debt plan just because prices look cheap. Stability comes first. Think of your portfolio as a library of cash-generating assets and steady businesses. That collection earns you time and options during tough periods. If you are young, your time is on your side. Use it to buy durable assets. If you are closer to retirement, focus on preservation and reliable income streams. You may want fewer swings and more protection. The goal of this playbook is not to win every trade today, but to stay solvent and patient for years. That mindset compounds wealth over time. A recession is a pit stop, not a finish line. Take care of the basics and you'll emerge stronger. You may feel fear, but you can act with a clear plan. Clarity reduces stress and changes outcomes. Let your plan fit your life, not some headline you read online. Make it practical and repeatable. Treat money as a tool, not a statement about who you are. Your actions today shape tomorrow's options. Ask a friend to review your plan or use a simple checklist. A second pair of eyes helps keep you honest. If you want, start with a small amount and scale up as you gain confidence. Momentum builds with consistent effort. The key is consistency, not perfection. Small progress compounds over years. In a downturn, the strongest allies are patience, clarity, and reasonable prices. Hold steady, and you may see the value emerge. Let's recap quickly. Reinforce your fund, trim spending, set up automatic investing, buy quality, diversify, and stay disciplined. That combination creates resilience and long-term growth. If you found this helpful, please like, subscribe, and leave a comment with your own recession plan. Thanks for listening, and see you in the next video.